Hey everyone, today we are diving into a concept that's right at the heart of Wall Street, security analysis. We're going to break down how the pros figure out what an investment is really worth, and we'll give you a simple framework to help you think the exact same way. So let's jump right in.
All right, so let's kick things off with a big question. How does Wall Street actually put a price tag on a company? You might imagine it's all super secret formulas and crazy complex algorithms, but the truth is, it's actually a lot simpler, and frankly, way more interesting than that.
To get to that answer, we've got to start with the basics. So what even is security analysis? What does a professional analyst really spend their days doing?
At its core, it's this, a disciplined way of looking at stocks and bonds to figure out if they're a good place to put your money. It's not about day trading, it's not about chasing hot tips, it's really about doing your homework. Think of an analyst's job as being part detective, part historian, and even part fortune teller. They dig in and describe the business, pore over the financial results, and spot the strengths and weaknesses. Then comes the tricky part. They try to estimate what the future holds, all to boil it down to one simple opinion. Is this thing safe? And is it a good buy? Okay, so here's where it gets really interesting. That analysis, it usually splits down two totally different paths, and it all depends on whether you're looking at a bond or stock. And trust me, this difference is absolutely crucial. And the difference really just comes down to one core question. See, for a bond, you're all about safety. You're asking, will I get paid back? The answer to that is found by looking at the company's past. But for a stock, you're asking about valuation. What could this be worth someday? And that depends almost completely on guessing about the future. So let's walk down that first path for a minute. Safety. When you're analyzing a bond, the past is really your best friend. You're looking for a solid history, proof that the company can consistently pay its bills. It's all about evidence, not trying to read a crystal ball. So how do you actually measure that safety? Well, a really key test is called earnings coverage. It asks a simple question. How many times over could the company's earnings pay for its yearly interest costs? For, say, an industrial company where earnings can bounce around, our source materials suggest you'd want a nice, safe buffer of at least 7 times. For a more stable public utility, that buffer can be a bit lower, maybe around 4 times. So the whole point for bonds is this. Companies that have a long history of easily covering their debts have proven they can weather storms. That strong track record is the most reliable clue you're going to get about whether they'll be safe in the future. All right, now let's switch gears and talk about stocks, because this is where the game completely changes. Now, the past is still important for sure, but a stock's value is really a claim on its future earnings. And that immediately slams us into a huge, kinda uncomfortable question, doesn't it? If a stock's value is all about predicting the future, how good can any of us really be at that? This very problem leads us straight to what you could call the great paradox of security analysis, this dangerous illusion of precision. You see this all the time with those high-flying growth stocks, right? To justify the crazy prices people are paying today, analysts build these incredibly detailed spreadsheets projecting earnings growth not just for a few years, but for decades out. And yeah, it all looks very, very scientific. But here is the trap. The more a company's value is tied to those distant, uncertain, hazy projections about the future, the more fragile it actually becomes. A tiny little error and an assumption you make today can snowball into a wildly incorrect valuation way down the road. So the complexity creates this illusion of accuracy, while in reality, it's just increasing the risk that you're going to be massively wrong. The legendary investor Benjamin Graham, who literally wrote the book on this stuff, he put it perfectly. He said that in all his years on Wall Street, he never saw a dependable valuation that needed more than just simple arithmetic. Whenever the fancy math comes out, he said, that's a warning sign that someone is trying to make a wild guess look like a scientific fact. So, if all those complex models are so dangerous, what's a regular investor supposed to do? Well, the answer is to choose clarity over complexity by using a simple, really practical framework. So instead of trying to be some kind of mathematical genius, you can use a simple 2-part process that keeps your analysis grounded in reality. Here's how it works. First, you calculate what's called a past performance value. This is what the stock would be worth based only on its historical record. Maybe you average its earnings over the last 5 or 10 years. Then, and only then, do you adjust that baseline number up or down based on what you think are clear, reasonable expectations for the future.
The power of doing it this way is its intellectual honesty. It forces you to draw a bright line in the sand between what you actually know, the company's real track record, and what you're just estimating, its very uncertain future.
And that brings us to the key takeaway. Sound investing isn't about having a perfect crystal ball. It's about admitting that the future is uncertain and building in a margin of safety. That's a buffer between the price you pay and the value you calculate to protect yourself for when you are inevitably wrong about something. Which leaves us with a final thought to chew on. Maybe the real secret to long-term success in investing isn't found in some frantic effort to predict the future, but in the much more humble discipline of just preparing to survive it.